Welcome, everyone, and thank you for joining our discussion on why growing tech companies need a sales tax strategy now. My name is Michael Valerio. I'm a partner and the industry leader for Cherry Bekaert's technology practice. In our work with clients, we're finding more and more tech companies are vulnerable to sales tax issues as state laws surrounding them evolve all the time. It's the number one issue that comes up in an M&A transaction, and therefore can be one of the biggest roadblocks to a successful exit. Unidentified tax obligations can create significant liabilities that are expensive to clean up. So that's our purpose here today, to help you and your company better understand how state economic nexus rules impact tech companies, what to look out for, and how to implement best practices moving forward. With that, I'll turn it over to Josh Howe and Chris Grimes from our state and local tax practice. Josh, take it away.
Thanks, Michael, for that introduction. As he said, I'm Josh Howell. I'm a state and local tax senior manager here at Cherry Bekaert, along with Chris Grimes, who's also a senior manager. And we focus extensively on technology companies in our practice. And Chris actually does a ton of work on M&A due diligence in this space, focused on sales tax and indirect tax. So we just want to spend the rest of our 30 minutes today talking through some, main issues that we see impacting tech companies, kind of how we got here, how it's impacting, the deal space and what you're seeing in M&A due diligence, some of the common sales tax issues that are driving this, and finally, how you can put in compliance and remediation best practices going forward to address some of the complexities you're facing on the sales tax front. Before we jump to the meat of the presentation, I just want to ask everyone, if you have questions, please put them in the chat box. We're happy to address those, although we are limited now to 27 or 28 minutes for the rest of the webinar. So if we can address them during the webinar, we'll get back to you afterwards. And so the first piece we'll talk through is Nexus, and that's really the how did we get here piece for tech companies and sales tax. So most of you are probably familiar with a 2018 Supreme Court case called Wayfair. I think Wayfair's would prefer to be famous for what it sells, but they're also famous for the Supreme Court case that impacts sales tax compliance for so many companies. And what that Supreme Court decision allowed states to do is essentially say, you no longer have to have a physical presence in the state for us to require you to collect sales tax. We can require you to collect tax if you have enough of an economic presence. And we'll get to that on the next slide. But this slide kind of covers what we looked at pre-Wayfair, middle of 2018 and prior. And there's a previous Supreme Court case that essentially laid the foundation and said, our states can only require you to collect sales tax if you have a sufficient physical presence in a state. And that can be through offices, employees based in the state, employees that travel into the state quite a bit to visit customers and conduct business, third-party sales reps, either in the state or making frequent visits, even if you make sales of technology equipment and then also sell installation, but hire a third party in the state to do installation for you, that third party being present in the state, sort of acting on your behalf. So there's a lot of ways you could create physical presence, but states were really limited based on the interpretation of that older case and who they could require to collect tax. And now because of Wayfair, things are different. So as you can see from this chart here, every state that imposes a sales tax has now passed an economic nexus law, implemented a regulation, or just through Department of Revenue guidance, said that we can require you to collect tax if you exceed a certain level of economic activity in the state. And typically, that threshold is a sales threshold of $100,000 or more over a 12-month period or a calendar year period. As you can see, some states are generous. They allow you a little bit extra leeway if you're a small seller, especially some of the big states like California, New York, and Texas. So you don't have to register in those states until you hit a much higher threshold, which alleviates some of the burden on you. But as you can see from the left side of the slide, most states use the lower threshold. And if you're a tech company selling expensive tech equipment, software, it's pretty easy to get over that threshold in a state in a calendar year and create that sales tax obligation. And that's why moving from that physical presence nexus standard to physical presence or economic nexus standard has expanded the sales tax collection obligations for many, many tech companies over the past 3 years. And there's one other piece that states can implement, and some states have, is in addition to, or alternatively, to the $100,000 sales threshold, some states will have a 200 transaction threshold as well. And the reason that's important is depending on your business model, you could easily hit that 200 transaction threshold well before you hit $100,000 in sales. This slide kind of talks through an example of if you're a SaaS company or a managed service provider that bills your clients on a monthly basis. So you would have 12 transactions over the course of the year for just one customer in a state. Well, if you have 17 customers in the state times 12 transactions, you're over the threshold. And if those monthly bills for the software are only $200, $250, you're looking at $40,000 or $50,000 in sales, but 200 transactions creating nexus for you in the state and requiring you to collect tax. So this is all just background for you to understand why your sales tax collection obligations may have expanded greatly. And now Chris is going to talk through how we're seeing that impact the M&A space and the increased scrutiny that companies are facing there. Chris.
Yep. Thanks a lot, Josh. And definitely on point. Lots of changes have happened on the Nexus front with the Wayfair decision taking place. We're seeing so many different filing obligations taking place for businesses. So this kind of leads us into the common sales tax issues that which we're seeing when we're assisting companies with due diligence. So leading in from Nexus is what creates a sales and use tax registration obligation. So one of those key issues that we are seeing a lot with technology companies are they are typically registered in their home states. They are going about collecting and reporting sales tax as necessary wherever they're based out of. But they have not kept up with these changes in tax laws where there's additional registration obligations, or Nexus has been created in additional states, which has led to additional registration obligations. So that's one of the core issues that we're coming across. The other issue that we see pretty regularly has to do with improperly classifying products or services sold, resulting in an incorrect tax decision, meaning that if you're selling something such as electronically downloaded software and you decided to tax it as if this electronically downloaded software qualified as a software as a service, you may be resulting in an under collection taking place due to electronically downloaded software being taxable in numerous jurisdictions and software as a service just being taxable in just under 20. The other key issue, and this isn't just limited to the technology industry, this is just rampant across all companies for the most part, has to do with the collection of exemption certificates. Now, when a business has nexus in a state and they are making taxable sales into a state, there's going to be an obligation to collect sales tax on those taxable sales. If sales tax is not collected, then there's an obligation to collect exemption certificates or some other alternative forms of documentation. If these exemption certificates are not collected, even if a company is a 501c3 or universities, hospitals, churches, etc., that are traditionally not subject to, that may not be subject to sales tax, an auditor could suggest that these transactions are still taxable due to not collecting the appropriate documentation. So it's very important to go about collecting these exemption certificates. So the reasons for the M&A focus on sales tax, really, why does the purchasing company care about what the target company has done historically? So one of the most clearest reasons why is not only does the purchasing company acquire the assets, the customers, the employees, and things of that nature of the target company, they're also going to acquire any type of risk that was associated with that particular company, unless certain criteria have been met, such as getting tax clearance certificates. So if a target company ended up having, say, $250,000 in sales tax risk that hadn't been addressed due to not complying with Nexus standards, as that company is acquired, that $250,000 in risk now becomes the purchasing company's risk. So there's a definitely an interest for the purchasing company to be aware of this when the purchase takes place. Another issue is really over the last few years, there's just been an increased focus on sales tax audits taking place, and that's simply because of the complexities with both determining whether or not sales are taxable, like what type of thing is being sold, typically requires contract review, there's services involved, and then also just with the Nexus standards changing, as Josh had discussed. These changes have completely, it made it very difficult for technology companies just to keep up with the appropriate tax laws and to come to the appropriate tax conclusions. And then finally, really with another issue that's kind of key, but really relates to just the customer service experience. So we're going from a point in which a business basically has, the target company has not been collecting sales tax from their customers. However, due to research and finding out Nexus has been created, sales are taxable, now we're changing what's being done, and now we're going to go and begin collecting sales tax. So it's important to basically have this communication take place so that the customers are going to be aware of what's going on. So it may be helpful to go through somewhat of a case study here, and it's going to incorporate some of the things that we've already previously discussed. So when we think about the target company, like a standard target company being a SaaS provider, the SaaS provider has employees at locations within 3 states. So that means we have physical Nexus in 3 states. There's physical Nexus, therefore an obligation to collect and report sales tax on taxable sales. So this company has never collected sales tax anywhere throughout the U.S. other than those 3 states in which the company had Nexus. So good news for those 3 states, probably unlikely there's going to be a significant amount of risk, right? Unless there's incorrect tax decisions or missing exemption certificates. Now, there's an investor that's come about, this purchasing company is performing due diligence on the target company. And as they're going through the whole due diligence process, they've identified that not only do those 3 states, which the company is currently registered and filing in, have Nexus, but also 9 other states do as well, going back to 2018. And this has to do with the Wayfair decision that took place. Economic Nexus has been created. Target company was unaware of this law change, and they just continued making sales and making sales and making sales, and just failed to register and begin collecting sales tax in those particular jurisdictions. Now the buyer is suggesting that since this risk exists, they're going to want to make a deduction from the actual purchase price, or they're going to want to have funds escrowed in order to cover these liabilities for the unpaid taxes. So the target company hears about this issue, and they're like, okay, what can we do to resolve this? We don't necessarily want to have this adjustment take place or have to escrow a bunch of funds. So can we mitigate this by some means? So the target company goes through a process and outreach, trying to connect with clients to either back bill taxes or to collect documentation to support exemptions. And they do a good job. They collect a fair amount of documentation and tax, etc. However, there's just not time typically. And when a due diligence is taking place, it's crunch time. It is a very rapid process. And given the limited amount of time, the company wasn't able to reduce the entire liability, and it resulted in a significant reduction to the actual purchase price. So I'll be kind of brief on this slide here. This kind of reiterates what we were already talking about with Nexus and taxability, but there's a handful of different areas in which when due diligence is being performed, that the purchasing company is going to focus on. Are you registered in the right jurisdictions? Are you coming to the right taxability conclusion for these types of things that are being sold? Software, maintenance, implementations, etc. How are you sourcing revenue? Sourcing revenue is an issue that could be very simple. If I had a brick and mortar store and it's in Atlanta, Georgia, and everybody shops at that brick and mortar store, so it's all sourced to Atlanta, Georgia. But what if you're selling services and the service provider is in Georgia, but the target or the company that you're selling to is in Texas? And the same thing applies to electronically downloaded software. What if I'm downloading software into Illinois, but the company using it is actually in Texas? It's a lot of variability and a lot of confusion that companies have when it comes to appropriately sourcing revenue. And it's very easy to understand why states are going after companies for audits, and these adjustments to purchase prices are occurring through due diligence. With that, hand it over to Josh.
Yeah, thanks, Chris, for that. And on the next few slides, we'll just talk through some of what Chris teed up already, just on some of the main issues that drive errors for tech companies that are selling software, technology products, et cetera, and just make sales tax compliance complex for these businesses, especially ones that are new and growing, haven't been able to pay a lot of attention to it as they've just focused on growing the business. As Chris mentioned, the way that software is taxed in a state is less based on what you're selling and more on how it's delivered. And as a software seller, you might say, well, that doesn't make any sense from a practical perspective. I'm a software provider. Who cares how the customer gets the software? And I might agree with you there. But unfortunately, you do have to pay attention to this because, as you can see from this chart, you will have very different taxability on your software depending on how you provide it to the customer. So, and part of the historical background for that is, sales tax laws were drafted largely to tax things that were tangible, right? So this first category says, well, pre-written software, even though software is an intangible that's delivered on a disk or a hard drive, is taxable everywhere, because they really just look at that tangible piece of property that the software is being delivered on. But alternatively, if you skip down to the next one, software delivered electronically, some states no longer see that as delivery of tangible property, and they will say, well, it's not subject to sales tax because it's electronically delivered. The customer didn't get something, tangible that they can feel, touch, receive in tangible form. More and more states are taxing those, but you can still see a pretty big gap between the 46 states that impose a sales tax and the roughly 30, low 30s that tax electronically delivered software. Skipping over custom software, SaaS is an even different model, as Chris mentioned. So there, the vendor, you as a technology company, is hosting the software. Your customer, through their laptop or mobile device, uses the internet to access the software, but they never get a copy of it. Nothing's delivered to them electronically or tangibly. They're just connecting to your servers and using the software. That way, even fewer states tax software delivered through a SaaS model. So again, you can just see from these examples that how you deliver the software really matters and something you should pay attention to. And then custom software, if you're not delivering something that's right off the shelf, if you're more getting requirements from a customer and creating software from scratch, typically not taxable in most states. A few states do, but that's more often considered just a professional service that you're providing that's not taxable. Adding complexity on top of, well, how am I delivering the software is, well, you're typically not just going to sell software and then go away. You're going to provide some type of software maintenance, installation, implementation, configuration, et cetera. And how you contract for those services and invoice them to your customers can drive the taxability of those. So Chris and I have both seen cases where companies just assume, well, most states don't tax services, so no big deal. All of our service revenue is not taxable, not a problem. And then on due diligence, we see that, well, you sold taxable software, and then these services were actually required as part of the sale. And so the state will say, hey, because you required the customer to buy these with the taxable software, we're also going to treat them as taxable. In some cases, if you're selling complex software and the installation and implementation, might be, upfront larger fees than the actual software itself. This can cause some serious issues. That's included in the key considerations on the side here. Whether the service, as I mentioned just a second ago, is optional or mandatory often drives the taxability. If all of your services are optional, again, most states don't tax a large array of services. So you're more likely to see a non-taxable treatment if your services are truly optional and the customer doesn't have to buy them with taxable software. And then, as Chris mentioned, how it's delivered and whether it's delivered on site in the state or it's delivered remotely can play a part. with COVID and people working remotely, the delivery of remote services has kind of exploded and really driven even more complexity for companies as they determine, well, is this service taxable and which state should it be sourced to? Because my person who's providing the service is in state A and my customers in state B. And I won't spend too much more time on these because we really want to get to the point where Chris is talking through, well, how do you put some compliance best practices in place to deal with this complexity? But just to touch on this quickly, there are plenty of cases where companies, in 2021 are not necessarily licensing software or providing a technology product, but they're using technology infrastructure to provide a service to a customer. And understanding the difference is big from sales tax purposes, because again, Chris and I have seen companies that would say, hey, we're just using software to provide a service. Services generally aren't taxable. And then we advise them, well, data processing is a service that is taxable, in fewer than 10 states, but a handful, including some bigger states. Information services are taxable in more than 10 states. And so even if you're just using technology to provide a service, if it falls into one of these categories, which many can, you're looking at a taxable transaction where you need to be collecting tax from your customer. So really understanding, even if you're not a software licensing company or selling technology products, like what is it that you're providing and is it taxable is key. And as you can see, digital goods are taxed in more and more states these days. And you got to think outside the box here, because I think most people look at it from the traditional, I'm downloading music or movies or a book, and the number of digital goods that companies provide these days, it's really exploding. And some of them don't necessarily fit perfectly within a state's definition of a digital good. And so you got to be very careful if you're selling something like that into a state to understand, is it taxable or is it not? I'll stop there because we really do want to get into Chris going through, what are some of these best practices? And Chris has already touched on the sourcing piece in a previous section. So I'll turn it over to you, Chris.
Thanks a lot, Josh. So moving on to compliance and best practices. So really, what are the steps that are required for a business to begin registering, collecting, and remitting sales tax? So this is going to kind of like look back to what some of these things are that we've discussed earlier. But really, what the key starting point with almost every sales tax exercise you're going to go through is, does Nexus exist? So first thing you want to do is get a good understanding of the whole Nexus footprint of your business. Where does this physical presence exist? What do your sales look like, and where have you exceeded economic thresholds? Once you get a concept as to what are the states in which Nexus exists, then we do a step down further, and you also look into finding out whether or not the sales that you're making, are they subject to sales tax? If you find out sales are subject to sales tax and certain jurisdictions, and you do have Nexus in certain jurisdictions, then that's when you continue the process forward. You look to see, when was Nexus created? All right, well, if Nexus was created 2 years ago for your business and sales were taxable starting 2 years ago, it's very likely that your company is going to have a historical sales tax liability. So it's key that you go back, try to find out how much this historical sales tax liability is, and quantify all sales sourced to that jurisdiction that were subject to sales tax. And then really at that point, that's when you can actually consider like moving forward through any type of remediation and registration and getting towards the end goal of actually collecting sales tax. So I will say that one of the questions I do get asked pretty regularly is, all right, I see I'm taxable. I know I should have been collecting tax 2 years ago, but why don't I just file prospectively? And it's a very common question. Some companies do go this route. They're more aggressive and they're just going to just register with a start date today, begin collecting sales tax going forward. They want to stop the bleeding. What is the risk of taking that approach? So as we talked earlier about due diligence, sales tax is a hot topic. So if your intent is to sell the business one day, it's very likely that these issues are going to come up. So if you just register 15 different states with January 1st, 2022, that's probably going to be a red flag that's going to pop up most likely when due diligence occurs. And then there's going to be additional review that takes place to look at those historical sales. Another issue really is VDAs will no longer be an option if you register. So you can't go back and clean up back taxes and potentially avoid any type of penalties. And same thing with the audit side of things. If you do register with that date of January 1st, 2022, and you have all these different historical sales that were taxable, if an audit takes place, it is highly likely you'll be assessed to some type of non-filing penalty, non-payment penalties, and things of that nature. And it'll probably be a bit more challenging to get those penalties waived. And then the final topic is, this really just relates to actually completing a sales tax registration application. There's, I think, about like 20, 25 states or so that when you're going through the process and you're completing the application, before the application is submitted electronically, prompts will show up, and it says, under the penalties of perjury, all the information you're inputting is actually correct. And then if you suggest a different start date than which you know, there could be some risk along those lines as well. So a decision's been made that you do want to remediate the back tax piece. So what do we do from there? What are the options? What are the benefits? So the starting point when we're considering remediation is always the same place. Do these states have amnesty? And what does the amnesty entail? Meaning, is there any potential waiver of historical sales tax that should have been collected, interest that should have been, interest that's due, penalties that are due? So if the state offers amnesty, that'll very likely be the route that you're going to want to go to mitigate any potential out-of-dollar costs. If there isn't an amnesty program in place currently for that jurisdiction, then we have two different options. One is we can go the route of a voluntary disclosure agreement, and these are typically only advised if there's a high amount of risk, say $15,000 or greater. If you go the route of a voluntary disclosure agreement, non-filing penalties, late payment penalties, things of that nature will very likely be waived. Another benefit is the look-back period will be limited to match up to the statute of limitations, or it could be limited just going back to if Nexus was created at a more recent point in time. And then we also have that other a nice benefit too, is that a lot of states actually offer payment plans. So if you're going through a couple of VDAs, you're not going to get completely hit all at once, where you have to have this big cash outlay to pay for all these historical sales taxes that were due. It could be a payment plan worked out with the state. It could be stretched out over years, basically, so it's not such a ding basically happened to the company. And then we also have, we have those states that are like $15,000 and more in exposure, but what about the smaller states? We still want to get them registered, and we still want to begin collecting sales tax in those states as well, just so we don't get to a point in which there's a lot of sales tax owed in those states as well. So for those ones, that's when you're just going to go the route of completing a registration application. You'll put in the appropriate dates as to when Nexus was created, and then the sales tax returns will be filed historically. It is a good idea too that when those returns are filed, that penalty waivers are going to be submitted if the penalties are substantial as well. That the states won't necessarily 100% approve them, but there's a chance that they'll approve them. Now, before we actually do jump in and start, going down that route of completing working on remediation and going to VDAs and amnesty and returns, we want to make sure that you actually need to pay the tax. So there's a few different routes that we can go to get from I've quantified that I owe tax to remediation. In between there's the mitigation phase, and the mitigation phase is there's two parts to a transaction. You have the seller and you have the buyer for any typical sale that happens on a daily basis. Just because you're making a taxable sale and Nexus existed and you were required to collect sales tax, but you didn't, it doesn't necessarily mean that your buying company, the purchaser, hasn't paid use tax to the state, been assessed sales tax by the state, or gone through VDA, then processed themselves to report these types of taxes. So there's a lot of options to work through to mitigate sales tax. One, just the confirmation the tax has already been paid. Two, does your company that you're selling to, do they have an exemption certificate to provide? Or three, probably not the most favorable option, but can you go back and bill the company sales tax? I know a lot of technology companies have contractual language that says company or customer is responsible for payment of sales tax. And while it's not going to necessarily fly when a state's auditing you or due diligence is performed. It does give you a means of going back to that company and going to collect that sales tax to recoup anything that you're going to be paying to the state or through due diligence. All right, so now we have tax automation and compliance. So when we're thinking about the sales tax compliance burden, it's great that we are moving forward. We're getting registered. We're ready to collect sales tax. But really, what's the downside of this? What happens when we do take this process? We do start going through this process. So certainly, we're going to be collecting sales tax in more states. We've registered in additional states. We've got the applications processed. We're going to be filing returns. Now there's more returns that are filed, more returns that need to be processed, more reconciliations, more payments, more notices, all these more things happening. So what that means is more resources are needed. And the people that are actually managing this function to make sure that tax is being paid accordingly, there's potential missteps that could be taken along the way. What if we come to an incorrect taxability conclusion? What if we're not, what if we fall behind on more states that actually need to have Nexus? So just because we identified all done this exercise and found that Nexus exists in a bunch of new states, that's a reoccurring process. You have to touch on that over and over and over throughout the life of the business until you're essentially either registered everywhere or registered at least in all the states in which your products and services are subject to sales tax. So another question here is, do you have the systems and resources in place to actually handle the sales tax compliance? So some of the key issues are, does my ERP system correctly source sales? It's important that the ERP system is not only collecting things such as like bill to addresses for your customers, but also looking into seeing if you can find out where the actual users are located at, where the software is delivered at. Collecting these additional data elements will get you a more accurate answer and get you to the actual correct tax decision. What about tax rates? Are these rate tables that are in the ERP system updated regularly? There's changes that happen to sales tax rates all the time. And if the rates basically fall behind in the table, then you could be potentially under collecting and over collecting on numerous sales. And then, of course, should I even keep this process in-house and complete it manually, or what are the options for automation? I mean, automation is definitely like a hot topic nowadays, and there are many softwares out there. But like one of the software companies that we work with pretty regularly in implementing these systems, I mean, it'll allow you to go from a point in which you are not collecting sales tax anywhere to getting the appropriate rates per jurisdiction, getting the appropriate tax answers per jurisdiction, updating taxability conclusions like due to law changes, updating rates, automatically filing sales tax returns. It's a tool that we use pretty regularly as we work with our clients. But automation is a great process, especially if you have a lean team. So invoicing, logistics, and sales tax systems. And again, this is kind of almost just reiterating what we were just talking about with the automation piece. It really is just, does your ERP system have what it takes in order for you to not have a huge burden come into play where you're updating tables and updating taxability and filing and processing returns on a monthly go-forward basis? Or does it make sense to use some type of like bolt-on engine that allows you to automate the whole process? It's a really useful tool for sure. All right, Josh.
Thanks, Chris. And one other consideration, and Chris alluded to earlier, relates to exemption certificates. It comes up a lot in due diligence and in audits. It's really probably the most often audited issue or problem issue that we see for clients during audits, because states can be big sticklers for having every single exemption certificate and having all of those exemption certificates properly completed. So if information's missing, sometimes they'll reject them. As you can see here, some of the issues, if you're scrambling to get them at the last minute, you just may not be able to customers go out of business and you can't get the exemption certificate retroactively. So you're really having to eat that liability. And when you can't get these, if you're in the course of an audit, some of the audit errors are projected, extrapolated over all of your sales. And so sometimes small errors can become bigger, financial issues for you during an audit. So really a key area to focus on. And the best place to start is really, kind of the who, what, when, where, right? Who's going to collect the certificates? Who's the best person within the organization to do that? Who's going to validate them? That probably needs to be somebody who has some knowledge of what has to be on the form and what it means to be properly completed, and who's going to manage the renewal process, because certificates, depending on the state, aren't good, for 10 years. Sometimes they need to be renewed annually, sometimes every 3 years, and understanding that renewal process is key. And then storing them. So if you're being audited, if you have an exit strategy for the company, you need to produce these for due diligence. Where are you keeping these, and how can you produce them quickly? You can purchase an exemption certificate management tool. As Chris mentioned, we work with software companies that provide these, or have a manual process. It kind of depends on your volume and how that impacts your business, and how much you need to keep up with. But it's certainly something we could advise you on, depending on the nature of your business and how many exempt customers you have. And I'm going to turn it back over to Chris to wrap up.
Thanks again, Josh. So really the last topic here, last slide here that we're going to be addressing is really the filing sales tax returns. So unfortunately, just like there's complexities with technology, there's also complexities with filing sales tax returns. And it's simply put, just because of the enormous amount of variability that takes place between each state. So we have different filing frequencies. Some returns you do monthly, quarterly, semi-annual, etc. Different methods of filing. Most states are going to accept online filing and electronic payments, but some states also request prepayments to take place, paper returns to be filed. And then really what do you do with your credits and things like that? How do you make sure that the credits are actually being applied accordingly? So what if your credits to a local jurisdiction exceed the credits or exceed the actual sales to a jurisdiction? How do you go about tracking this and making sure you're taking advantage of all the credits, getting the returns filed? And really the key to making sure this filing process just runs smoothly is just, you have to be diligent and you have to stay organized.
Thanks everyone for attending. We know we ran a little bit over time and are not able to address questions right now, but we do see some in the chat box, and we'll be happy to connect with you after the webinar to address any issues or questions you might have raised. And if you need additional help, feel free to reach out to us. Our contact information is here, and we know tech companies' sales tax obligations are only growing, so we're happy to help you navigate those. Thank you very much.